Ladies and gentlemen, good day and welcome to the Ugro Capital Ltd Q2FY25 conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator. Please note that this conference is being recorded. I now hand the conference over to Mr. Deepak Khetan, Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Sagar. Good afternoon, everyone. I welcome you all to second quarter FY25 earnings call of Ugro Capital Ltd. We will have a short presentation from the management, followed by Q&A. In case we are unable to answer all your queries today, you can connect with us post the call and we'll be happy to talk to you. Discussion done today are subject to the disclaimer made in the earnings presentation, which has been already uploaded on exchanges and our website. I'll now introduce our management. We have our founder and managing director, Mr. Sachindra Nath, there. Next to him, we have our chief financial officer, Mr. Kishore Lodha. Next to him, we have our chief technology and operating officer, Mr. Sharad Agarwal. Opposite to Mr. Sharad Agarwal, we have Mr. Amit Mande. He's our Chief Revenue Officer. And next to Mr. Mande, Mr. Anuj Pandey, who is our Chief Revenue Officer. Chief Risk Officer, sorry. I'll hand over the call to Mr. Nath now for opening remarks.
Thank you, Deepak. Good evening, everyone. Actually, it is a matter of very great pride for Ugro, because in this quarter we reached our milestone of 10,000 crore. For a company which is technically 6-year-old company, started in 2018, a company which lost roughly around 3 years' time, both in liquidity crisis driven by ILFS in 2019 and COVID crisis of 2 years in 2020 and 21, 22, to reach a milestone of 10,000 crore as a pure play MSME financing business is what we feel is a matter of great satisfaction. When we started and the idea of creating India's largest small business financing platform, it was an idea which was enshrined in the thinking that we have seen multiple category of financial services, non-bank lenders to emerge over the last 3 decades. We have seen very large lender in consumer financing. We have seen very large lender for second-hand vehicle financing. We have seen few lenders in gold loans. We have seen few lenders in vehicle financing. But for India's largest underserved credit market, which is MSME financing, we always felt that we need to solve the problem of credit for small businesses of our India. Small businesses are backbone to our economy. And they are not just backbone to our economy, they also solve one of the largest problem of our country, which is employment. Today, the 90 lakh crore of gap just not is the credit gap, but it also represents aspirations of large millions and millions of Indians who reside in tier 2, tier 3 towns, who have no other alternative employment opportunity but to go and get employed with MSME. We have been able to contribute to that and have been part of our nation building journey is a matter of great satisfaction. More so, I think so, in such a short period of time, having been able to build a business of 10,000 odd crore, having raised almost 2,800 crore of equity capital commitment, having support of more than 60 plus lenders, both domestic banks, global development financial institution, having partners in form of co-lending of more than 10 banks plus large NBFC, is also a testament that this management team and the support of our shareholder and board has been able to deliver what our peer set has been able to achieve in probably a decade or more than a decade. So our short operating journey of 3.5 years is really gratifying for us as the management. Second, what we feel really proud about. When we started, one of our core thinking and pillar was that India's MSME credit problem can be solved through the lens of data and technology. And that's why we call ourselves a data tech company. But given that we, in the fintech world, which is largely focused on technology and doesn't look at the balance sheet aspects of the businesses, over a very long period of time, we were categorized like any other conventional NBFC. It was sometimes very disheartening, and sometimes we used to get frustrated why our investment and sheer focus on data and technology is not getting recognized. We were surprised that all of a sudden a jury led by Mr. Ramdurai, ex-chairman of TCS, and EY shortlisted us as India's best fintech lender of the year, and that award was given to us by Honorable Finance Minister. So the combination of size and scale, and probably third or fourth largest MSME financing company in a short period of 3 years, in spite of broader market difficulties, and being recognized as the best fintech lender is a matter of great pride, and I hope all of our shareholders would also feel very happy about it. Next, if you look at why we think so that the last quarter was a milestone quarter for us. It was a milestone quarter for us because whatever we have been thinking, whatever have been our aspiration, it looked like that our entire franchise came together and delivered to our promise. Our promise to create a large financial institution driven by institutional ownership, independent board, and supervised by a management team, and the focus on data and technology to this underserved market looks like that it is coming together. Why it is coming together? Because our last quarter was a quarter wherein we did the lifetime highest loan origination of 1917 crores. And vis-a-vis our first quarter, obviously there was a massive and significant jump. Second, we have been saying that where we think that the biggest opportunity and the service which we need to do is our micro enterprises vertical, which are basically small businesses spread across 9 or 10 big states, where we have to reach physically and set up our physical branches. Not only the ROA creation target which we have, and the ROE targets which we have, our micro enterprises vertical is the key pillar to that, but more so the power of the execution, number of branches which we have added and how they have delivered was a matter of great satisfaction. So our target of 250 locations by end of this year and 400 locations by end of next year looks really possible. Why I'm emphasizing? Because on this is sometimes it looks fairly simple that you open the branch and you deliver a loan volume, but it is actually fairly complex process. For us to find a geography where we could do business, find right set of people, and automate and design credit to a local cluster and combine with the power of our data analytics is a very complex process. But the learning curve of our first 25 branches, then the second 50 branches is more or less over. Now it is a templated exercise. We know the 400 geographies where we have to expand. We know how to hire and train our teams, and we know that how in shorter period of time we can become profitable, and that is coming in play. Third is, those who track us and those who believe that we will get to our target of 4% of ROA, which is predominantly an asset mix change from a 10% of asset which was being delivered from our micro enterprises vertical, which will go up to between 35 to 40%, looks like coming into play. And that's why in this quarter, we delivered 456 crore vis-a-vis 209 crore from our micro enterprises channel, which is that we were able to double the volume or more than double the volume in just one quarter. Sometimes when we talk that we have to expand our ROA, and this company would deliver superior profitability, actually because it comes at a lag effect of when we open branches, when we hire people, but this is the power of the distribution. When it gets fully set up and come into play, the size and the volume becomes naturally to us. And more than that, we have always been saying Ugro is an industry leader when it comes to the co-lending. For last 4 years, we have been saying that India's NBFC lending market is set for a massive transition from a purely leveraged business. It is becoming services plus leverage business. The power of the liability still continues to be in the hands of the bank. Yeah, and the power of generating assets and finding right set of customer, it continues to be a prerogative of NBFC. And rather than competing, we have to collaborate. Regulators actually decided to enable that collaboration in 2019, accelerated that in 2020, and Ugro has been working relentlessly to go and tie up and partner with bank and then create this co-mingled platform. And now it is coming in shape. Not only we have more than 10 plus co-lending and co-origination partner, but the real volume throughput is also started coming. And that's why we have highest ever co-lending volume in the last quarter, which was 650 odd crore. And last but not least, beside our rating upgrade, which happened in last quarter, wherein we have been taken to A plus stable long term and highest rating of A1 in short term. What is more satisfying that vis-a-vis the narrative of liquidity constraint, we have been saying that this for over a period of time, that this narrative of that banks are not lending to the NBFC. There is a ballooning of credit happening in NBFC, and we've been saying that that is not for our segment of the market. Both liability side and investor side have to differentiate between NBFCs like Ugro, which are focused on productive financing, which is MSME financing, versus retail credit, consumer credit. We are different than that, and we are treated differently. Both regulatory intent, both the banking intent and policy intent is to support institution like us, and that looks to be happening, and that's why our last quarter was the highest liability mobilization quarter. So in all, that's why we say that this was a quarter which was deeply satisfying because our distribution and liability franchise fired together. Go next.
I'll take a minute on this slide, and like Sachin said, and we've been giving rather direction that we want to take our ROA to 4%. One of the critical pillars in our ROA has always been the increase in yield by 150 basis points. What is important to notice in this is the jump in micro enterprises business, the contribution of the business going to about 11% of the total disbursement this quarter, rather 11% of the AUM at the end of this quarter. To reach to that 150 basis points incremental yield, our micro enterprise business, which is coming from 210 branches today, will start really accelerating with another 50 branches coming up during this year and 150 branches coming up next year. So when we look at 6 quarters down the line, we would be at about 400 micro enterprises branches, and the contribution of the AUM would be upwards of 30%, thereby a complete product and a product mix change at the AUM level, delivering 150 basis points incremental yield. The other businesses are also firing extremely well. There has been a growth across all segments of the businesses, all channels of the businesses, and they will continue to grow at a steady pace, while micro enterprises business will grow at an extremely fast pace, thereby delivering our desired goal of 30% AUM of micro enterprise business and this increased yield of 150 basis points.
Okay. Hello everyone. A short commentary on our portfolio. Overall portfolio performance continues to be stable. Our collection efficiencies for last few quarters are stable at around 96%. The gross NPA at the end of this quarter was 2.1% and a net NPA of 1.4%. In last quarter, stage 1 assets actually have improved over the previous quarter, and now it's close to 94%. We have been, if you look at the segments within the portfolio by products, we see a little bit of decrease in GNPA in our secured business loans and machinery loans, and a little bit of uptick on GNPA on business unsecured loans, micro enterprises and supply chain. I'll talk about supply chain first. and we have been talking about that for last few quarters. We have been winding down our vendor finance book for about a year now. We had a peak AUM of 722 crores. Today we are at 355 crores. And the reason we have been doing that was that business was not making commercial sense. It was at a yield which was not quite affordable for us. And because of that, there was some adverse customer selection as well. We started identifying problematic accounts there and started doing accelerated provision. And last quarter, we took a write-off of 16 crores for one large chunky accounts. We had a peak NPA of 52 crore. And now, whatever stress we had to see, we anticipate that we have seen that, and we don't expect any further stress in that portfolio. On business loans and micro enterprises loan, these are a natural seasoning impact which we are seeing and which are very well calibrated. We on a quarterly basis do a very robust statistical modeling to predict our credit cost for the current year and for the next 2 years. And we have been telling that the way our portfolio construct is and what our models tell us is that our credit costs will peak and then get stabilized at around 2% by end of next year. In the first half of this year, we are at 1.6%, well below that, and this is as per plan. But as we move forward, we anticipate that by end of next year, we would be around 2 or a little less than 2% of credit costs. So overall, the portfolio is behaving the way we thought it would. Move on.
On liability side, co-lending is one of our core pillars. We have been talking about this for almost 2 years now. And if you look at the progress, we are progressing really well on co-lending side. So if you look at the left-hand corner of the chart, slowly we are reducing on co-origination with NBFCs and gradually increasing our co-lending with banks and also on DA portfolio. This will be the trajectory going forward as well. Co-origination with banks we will try to increase, but however it is a difficult proposition. It will take some time to crystallize. Banks are more comfortable doing co-lending with NBFCs as of now because co-origination has to be done simultaneously where there are some mental blocks still exist. So probably it may take another 12 to 18 months before banks are more comfortable doing co-origination with NBFC. But whatever arrangements we have on co-origination with NBFC, slowly we will be trying to move it towards co-lending and once the portfolio seasons toward the direct assignment. So directionally, we have committed that we will reach 50% as a book. Directionally, we are there. We have already achieved 44-45%, and this trajectory is likely to continue. And if you look at the right-hand side of almost all our products are going into co-lending. So our product construct itself is designed in such a way that most of the products are now going into banks and they are well accepted. These are as per the policies, common lending policies, which we have agreed with the banks. So we are not facing too much of challenge on the other side. If you look at the balance sheet borrowing, as Sachin said, last quarter has been really good for us. If you recall that last 3-4 MPCs, RBI has been a little tough on NBFC lending by banks, and RBI has also been cautioning the market on personal loan as well as consumer loans. We are not into personal loan and consumer loans, so we never faced any issue. But since RBI has been for warning and cautioning banks to go a little slow on NBFC lending. But however, we have seen that in last 3-4 months, the flow has increased to us and we could support whatever asset engine required for the growth in the previous quarter. Signs post this quarter are also positive. Recently, we have announced a deal with DFC, which you may have seen, which is for $40 million. It is not only a deal which should be looked into isolation. It is in our continuous effort where we have onboarded earlier FMO, ADB, GMO, etc. And also it is for a larger social cause. So here in DFC, we have committed that 70% of the borrowing would be towards women entrepreneurs. So in some sense, we are, whatever is our endeavor is to promote the weaker section, women entrepreneurs, some of the aspirational districts of India. We are actively doing our participation in that segment, and we are trying to create a viability franchise around that as well. On financial number side, as we have discussed, this has been one of our best quarters in overall in terms of disbursement, AUM growth, as well as PBT and PAT. This time we have done a total income of around 342 crore, vis-a-vis 301 crore in the previous quarter. Last year it was around 253 crore. Net total income it is about 200 crore, which was 150 crore previous year, and about 165 crore in the previous quarter. Overall profit PAT is 35 crore, vis-a-vis 29 crore last year and 30 crore in the previous year. So there is about 17% jump quarter on quarter on PAT as well. So with this, we will like to conclude our management commentary. We will be very happy to take questions, if any, from all the participants. I am sure you would be eager to ask questions on the financials, on our outlook, on the markets. So please go ahead and ask your questions.
Operator, we can open it for
Sure.
Q&A, please.
Yes, sir. Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question can click on the raise hand icon tab available on your toolbar or on the Q&A tab available on your screen. Kindly turn on your mic when the operator announces your name. You may also post your text questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Avinash Singh from MK Global. Please go ahead.
Yeah, hi.
Avinash, your line
Am I
is
audible?
unmuted. Yeah. Yes, sir, you're audible.
Yeah.
Please go ahead.
Yeah. Thanks for the opportunity. Two questions. First one, if you can help with some color on GNPA on this off book and on book. So I mean that on the overall AUM, of course, you have given segment-wise disclosure. That's very clear. Just to sort of get idea if at all there is any difference. That's one. And on the overall level, I mean, with the supply chain pain now almost done, how do you see, I mean, the trajectory of, the GNPA as well as the credit cost going forward? Asking because, I mean, of course, supply chain pain is now largely done. But in terms of your business loans and secured micro are sort of moving asset quality moving in line with expectation, or you see some increased stress there? Thank you.
Yeah. Thanks, Avinash. So on overall GNPAs between on book and off book. So currently our overall at the AUM level it is 2.1%, and on the off book portion it is the GNP is around 1%, and that is primarily a function of the seasoning of that book. It is a relatively newer book because it is not more than 1.5 years old. In the long run, we expect that the overall AUM GNPA and the off-book AUM GNPA will converge because we don't differentiate at the time of sourcing and underwriting whether the transaction will be remain on book or off book. So that is the answer to the first part.
And also that co-origination, because we don't add to the denominator, is also...
So the on-book GNPA looks artificially higher at this point in time because for the co-origination part of off-book, where we have given FLDG, whenever a loan goes bad and the FLDG is applied, it actually comes back on our book. So the good part remains with the partner, only the bad part comes in, and hence the on-book GNPA looks higher. That's why for our kind of business, the best parameter is to look at the overall AUM GNPA. Now coming to the second part, yes, we are more or less, so 300 little more than 300 crores of supply chain book is left, which has currently about 35 odd crores of GNPA. We don't foresee any further stress coming in there. As far as micro business loans and unsecured business loans are concerned, they are tracking the way we expected it to be. The lifelong GNPAs and credit costs expected in an unsecured business loan, GNPAs are on the tune of around 4.5%. Translating to a credit cost of around 2.5%, and lifetime GNPAs in micro business loans are expected to be around 3 to 3.5%, translating to a credit cost of about 1%. We are slowly peaking towards that. We have observed in our portfolio the peak delinquencies are happening around 21st month. And the total seasonality of book is little less than that, but more or less we know, we have seen a lot of quarterly cohorts that it is likely to remain that way. So going forward, we don't foresee too much changes from percentage perspective or roll forward perspective for incremental NPAs.
Okay, clear. And quickly one, how is the competitive intensity, particularly in the secured side, both, the large ticket LAP and micro LAP, are there kind of, instances or rather increased instances of balance transfer in the market, or is it like business as usual?
No, so you're very right. There are competitive pressures, but largely on the intermediated channel prime LAP. This is because these are originated by the intermediary partners, and so once the customer does well on our books, there is a tendency for the customer to move to a lower yielding principle. However, having said this, on the micro piece, which is largely self-originated, direct originated business, the pressures on foreclosures and balance transfers is lower. In fact, very, very significantly lower than what the prime business is. And that is why as we grow our micro business, we will see these foreclosure pressures actually go down. But at this point of time, the foreclosure pressures are there on the book, but that has been accounted for in our annual operating plan. They could be slightly higher, but nothing very different than what we anticipated.
And Avinash, if I may add, I think so that is what is real advantage of Ugro. Like if you look at roughly around 425 plus crores of quarterly disbursement in micro enterprises vertical in this quarter, 200 crore in the month of September itself, we saw that almost 40% of that secured origination happened in what we call the medium ticket size, roughly around 35 to 45 lakh rupees per ticket size of loan origination at a much higher yield than what we see in our intermediated top 30 city channel. Vis-a-vis any of our peer set. So, micro enterprises secured lending, either there are lenders who only do this 5 lakh or 6 lakh rupees of loan, or there are large lenders who do only 1 crore rupees of loan. Probably we are the only lending institution which has the ability to go to a tier 2 and tier 3 location, and because we do both businesses, now in this year we launched this, that all of our location will not do 3 crore, 5 crore loan, but would also do direct origination of little higher ticket. They will also do, machinery loan. They will also do rooftop solar, and they will also continue to do micro enterprises, 10 to 12 lakh rupees of loan. So ability to monetize the platform across our product channel through a expanding distribution reach, coupled with a co-lending line and all our product being accepted, and thrust of the liability which we are getting, or a favorable treatment we are getting from the banking institution because we are an MSME, I think that it is coming into play big time.
So, Avinash, I hope that answers your query.
Sir, I believe Avinash sir has left the question queue. We'll move on to the next question. And the next question is from the line of Shailesh Kanani from Centrum Broking. Please go ahead, sir.
Thanks a lot. Is my voice audible?
Yes, Shailesh, very clearly audible.
Yeah. Thanks a lot for the opportunity. So I just wanted to ask a couple of questions. One, the interest income has been lower this time around on a sequential basis in spite of AUM growth. So reasons for that, and we have seen a good bump up in DA income. So the sustainability of the same, and how should we kind of build up in that in our model?
Yeah, sure.
So in two parts, so you should look at the interest income and DA and co-lending income together, because whenever there is higher DA and co-lending, naturally the interest income on balance sheet would reduce. So this is one part of the answer. The other part is that we have seen some compression in interest income this quarter, because if you recall that sometime in May, RBI came up with circular that wherever there are checks issued into the customer, and as long as the check is not banked, NBFCs and banks cannot charge interest on that. So essentially, wherever there is property involved, it takes about 1 to 2 weeks time to get the check cleared because of the process involved, which is fairly similar to every lender. So there again we had to take some amount of it during the quarter because and it came for the entire first half. So some compression came on the interest income side on that side also. So put together, this is where we are. Directionally on DA and co-lending, it should continue to grow the way we are. It should grow in same ratio as that of our AUM or slightly more than that, because our core hypothesis is that we should reach around 50% of the book balance sheet, which is now 45%. So incremental, whatever disbursement we would do in this quarter or quarters going forward, at least 40-45% would go into co-lending and DA. So the income directionally should be into that proportion only. Hope I have answered you clearly.
Yeah. Thanks a lot. That's helpful. Sir, one more thing on asset quality per se, especially on the unsecured portion. Since last year, we have seen various products, be it credit card and now recently MFI as well, have been facing some issues. So would you like to call out any areas of concern or anything which you have been experiencing, or how is the outlook over there?
Yeah, so Shailesh, there are a few things. We run this campaign called MSME Achha Hai, right? For last 1 year or so, we have been extensively, trying to educate the institutional side of the market, sell side, buy side, our banking, liability providers. The core hypothesis is MSME Achha Hai. We say MSME Achha Hai, and I would recommend that you should go through. But we do publish a report called MSME Sampark, which is an industry first joint data set driven report wherein DNB does the macro analysis. We take a customer base of 30,000 plus customer and we analyze the GST data and the banking data, and by sector we come and present the resilience of micro enterprise customer, especially our targeted customer segment, which is the 15 lakh turnover to 15 crore turnover. I would strongly urge and recommend at least the analyst fraternity that to differentiate between different type of customer segment and stress getting built up. So what you are seeing in microfinance industry, the consumer finance, and what we call the retail credit industry, actually does not have any direct correlation to NBFC, which are focused on MSME financing predominantly, because the consumer financing, microfinance industry, the challenge have been very small ticket level. In microfinance industry, what I read from public market commentary, it is largely the over leveraging of customers, which means that you do not assess the repayment capability, and it becomes eventually a distribution business. So as in the consumer financing or any retail product. And that's why there is ballooning of credit is happening, versus given more resilient small business economy in tier 2, tier 3 town, and what our data is showing, and because we do predominantly repayment assessment capability, we are not seeing those stresses which are building in other segment of the market, especially in the NBFC industry. And that is why it is reflective in our rating upgrade. It is reflective of we having highest liability funnel in this quarter. It is reflective that every bank, financial institution and DFI are actually expanding their liability to us. So, I know obviously it is difficult when there is a overall negative narrative about NBFC and ballooning of, stress building up on the, credit side and retail credit to stand out and say we are different. Sometimes it's difficult to absorb, but I would urge that data should be looked at, and that we, people like us, not just Ugro, but other entities involved in similar type of businesses would show a remarkably different performance, both on growth as well as on credit performance. Anuj, if you want to add something.
No, you're right. We also keep experimenting within the product construct to try out new things, and we continuously keep taking insights. But broadly now what we are doing, we are quite confident that it is not like what is happening in the personal loan or retail unsecured market. So the portfolio performance going forward is not likely to throw any surprises.
And whenever our data would show a different thing, we would the first one who would come and educate the market about it. Fortunately for us and for the broader peer set community which is involved in MSME financing, I think so it's a good time ahead.
Thanks a lot, sir. That's very helpful and comforting as well. Sir, just last question from my side. So we have got a rating upgrade as well. So any early indicators of respite on cost of funds or any reduction expected this year or next year?
So it is rate cut is on the cards. If you look at internationally, the inflation has been cooling off, and ECB, Fed, etc. Everyone has a reduced rate. So sooner or later we will also see rate cuts here. But as far as Ugro is concerned, we will definitely see some amount of rate reduction, but we think that it may still go up by about 5 basis points for next 2-3 months, and then it will start settling down, and then from Q1 definitely it should go down. It can happen earlier also, depending on how RBI reacts in next 2 monetary policy, but we are reasonably confident that with or without RBI reducing rate from Q1 next year, we will definitely see downside in terms of ROIs.
And as we have said that, if you look at our ROA targets for next 6 to 10 quarters, we have projected that we'll have a total cost of borrowing reduction of 75 basis points. We are confident with, our capital raise of 1,265 crore, which in the current year had added around 500 crore to our net worth. When our warrants would convert our capital adequacy, would again go back at a higher level. We will have a much sizable, scalable business operation, and more importantly, the profitability of company would double or from where we are today. And in that scenario, it is natural, and we are hopeful that both will have better rating from what we have today, and that maturity of our business would allow us to be in a better negotiating position to get better rate from all of our lending institutions. I think so right now we have not seen the direct benefit of rating upgrade into our pricing, but we have seen an incremental capacity of borrowing. So we have been able to sustain and maintain a very high level of inflow of debt capital into us that has allowed us to grow at a pace which we are growing, but we have not seen real advantage of that But as the liability funnel keep increasing, which means that we have better ability to negotiate the prices, rates would start going down.
Okay, sir. Thanks a lot and best of luck, sir.
Thank you.
Thank you. The next question is from the line of Narendra Khutia from Robo Capital. Please go ahead.
Hi, am I audible?
You
You're
are,
sounding
sir?
a bit distant.
Yeah, is it better now?
Yes, sir.
Yeah. Thanks for the opportunity. Congratulations on a great set of numbers. So, sir, my question is regarding our target of 4% ROA by FY26. Okay. So, given that we are currently at around 2% ROAs, it is kind of a steep task to go to that 4% of ROA. So, when do we see the actual ramp up towards this target? If you could throw some light on that.
Sure, sir. So look, and giving that kind of a hard number, obviously it is a reflective of our confidence of what we intend to deliver and how we will deliver that. But also, there are external circumstances which we have to be always, conscious of. Reason why we give that kind of a number, because to some extent it is a state of aspiration which we want to set for ourselves. And that's why we always like to what we give it to our board is what we want to give it to the market. Our target is of to get to a 4% of ROA when on a steady state basis as we exit the FY26 is a sequential target. We would like it to be delivered gradually on every quarter basis. This target of 4% ROA is a direct function of how our micro enterprises branches would expand. So the bridge is simple. We were roughly around 100 crore of monthly dispersal at when we exited FY24. We are at 200 crore of monthly dispersal right now as of September. We have expanded our physical location from around 75 to now around 165 or 170 in total, 200 in total. We would go to 250 by end of this year and around 400 next year. So the trick is that actually we have seen very good productivity performance as per our target. Our first set of 25 branches actually broke even in 18 months. Second 50 branches broke even in 14 months. Our target of this set of branches is between 9 to 12 months. We are seeing a 12-month of target of these branches getting break even. So we are hopeful that our learning which we had in last 2-3 years would come in play, and as we keep increasing our number of branches, the funnel of higher yielding micro secured business would keep adding to our ROA creation. So as we exit the FY26, and if we happen to achieve this asset mix of 35% odd of our total portfolio to be contributed our micro enterprises, we will surely hit the 4% ROA. And we are very, very committed and working 24/7 to deliver that. And hopefully you will monitor it up and keep us tasked to that target.
So thanks for that. And so second question is on your leverage, right? So what kind of leverage are we comfortable with? If you could share with that.
So I always say that we will be comfortable at 7-8 times leverage as well, provided the lenders are ready. So jokes apart, this is on the lighter note. We think that we can, with the maturity in the business and the kind of capital we have the capacity to lever ourselves up to 5 times. So 4 times would be a realistic, 4.5 times would be a realistic one in next 12 to 18 months time. But with this capital coming in, we can aspire for 5 times leverage as well.
And I would add, if you for any medium to long term investor, if you look at broader credit market, banking system in India generally are at a return on asset of around 1.5%. It ranges from 0.8 to 1.8 or 2%, but largely in the median range would be 1.2. but ROEs are in the range of 80% because banks are highly leveraged institutions. Now, there are two sets of NBFCs. Highly levered NBFC, which are AAA rated, which have been in existence for a very long period of time. Their also return of asset is around 3%, but leverage is again 6 times plus. That's why there is a high ROE. What we are promising that we will get to a good ROA profile, and our leverage in the medium term would still remain low, but we have offset that by an off-balance sheet asset and co-lending. But as the business would mature and you look at longer term, we would also get benefit of the leverage. So combination of our off-balance sheet co-lending, and when we'll get to better leverage, then this platform would deliver very superlative financial performance. So that's the hope. But obviously, as builder of an institution, we keep everything in mind what we have to build, not for today, not for a quarter, but for many number of years to come. But simultaneously to satisfy the need of quarter and quarter. So we balance the both, but we are very long-term oriented in terms of what we are building.
Okay. Great, sir. Thanks for answering my questions and all the best.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please restrict your questions to 2 per participant. And if you have any follow-up questions, you can rejoin the queue. The next question comes from the line of Anil Tulsiram from Contrarian Value Edge. Please go ahead.
Yeah. Am I audible?
Yes, sir, you are.
Yeah. Sir, first of all, congratulations for achieving 10,000 crore milestone. And
thank you.
All my questions on micro enterprises loans. So first is, how do you ensure these micro enterprise customers are not over leveraging themselves? So where I am coming from is, I understand we do underwriting at the individual level, and the husband, wife, and the kids may borrow again in their own name, and the household may become over leveraged. So how do you ensure this doesn't happen?
Can I answer? So, sir, I think you are confusing between microfinance and micro enterprises. We don't consider household income at all. We only consider business income. So our end borrower is always an entity. It's a micro enterprise. We take his reported income, the entity's reported income, as well as in case if he's dealing in liquid cash, we also add that liquid income back. And we don't lend to new to credit customers. So we also have his bureau and his last 12 months banking. So this is the way we calculate eligibility, his overall obligations, and hence overall his debt is very much analyzed before we give an offer.
Got it. So second question is, we are planning to scale up branches from 75 a year back to 400 by FY26. So how do we ensure that we maintain consistent underwriting standards across all branches, given how intensive the operating process is, and given the high attrition of staff turnover and the operational complexity?
Yes, you're right. When we scale up, the complexities will go up. But the way we have approached is that the core of underwriting and policy execution is centralized, and our product policy propositions are templated. So and the way a branch is structured is also a template. So each branch consists of 10 people, 5 to 6 in sales, 1 in credit, 1 in operations, 1 branch manager, and once the AUM goes up, 1 collection head. So typically now we have learned on how to scale up. There are tremendous exhaustive training sessions and repeat sessions across all functions on what we want to see. And the method and the documentation of that and the business rule engines are centrally coded in the system, which they access in our branches. So from consistency of underwriting perspective, we have taken a lot of steps so that we remain there.
And also as a process, when we enter it, so first and foremost, the 400 location where we will operate, we know today. We did a design of, a data analytics center actually, analyze roughly around 3,000 plus pin codes of India. looked at peer set lenders data and came up with the best 400 clusters wherein the credit quality of competitors are best, and that's why where we are operating. So we started with Tamil Nadu, Telangana, Karnataka, Rajasthan, Gujarat. Now we added UP, MP, Andhra and Maharashtra, and we know where we have to go. Second, when we enter into allocation, what Anu said, the policy parameter and how to analyze a loan is predefined and templated, and very limited judgment is allowed at the ground underwriting level. But also the delegation of power of underwriting till the time the branch reaches a critical stage is not delegated to them, but rather it is at a cluster approach. So every 5 branches would have a senior credit cluster officer, senior sales officer, and the delegation at the branch level would happen at a certain AUM level. And last but not least, in micro enterprises, while we analyze the cash flow and repayment ability, but we only do secured business, which means all of our loans have a physical collateral attached to that, whether it is a self-occupied residential property, commercial property, largely these two, and for certain other product like machinery and rooftop solar, we have other collateral. So I think we have reached to a state wherein we are the first pan-India micro enterprises company. All of our comparable and peer sets are in either in south or north, but we know the art of how we have to do it, and we will be able to execute fairly well across the country.
Got it. And sir, one last question.
Sorry to interrupt. Anil sir, sorry to interrupt. May we request you return to the question queue for follow-up questions, as there are several other participants waiting for their turn.
Okay.
Thank you.
We'll also limit our answers to shorter ones, don't worry.
The next question is from the line of Mohit Ansari from Hyderabad Investors Forum. Please go ahead. Mr. Ansari, your line is unmuted. Please proceed with your question.
Can we go to the next question, please?
Sure. As there is no response from the line of current participant, we'll move on to the next question. And next question is from Sahil Bambade from Cyrus Advisors. Please go ahead.
Sahilji, can we have your question, please?
Sahil sir, we have unmuted your line. Please proceed with your question.
Sahil, operator, I don't think so that we have a clear voice. Can you go to the next question, please?
Sure. We'll move on to the next question. Next question is from the line of Amit Jain from Citi Advisory. Please go ahead.
Am I audible, sir?
Yes, you are, Mr. Jain.
Yeah. So, sir, my question is regarding our micro branches. So we have taken an ambitious target and we are indexing a lot on micro branches to grow our AUM further. In fact, if we look at our growth in micro, it has been significantly higher than other segment. My question is, how are we so confident that we'll be able to maintain the credit quality in this channel? Considering the number that we are seeing right now, just give me a sec. I'm just pulling up the numbers. So in micro, our GNPA is around 40 crore and Q4 AUM was around 13 crore. So closer to 5%. I'm assuming that there would be no NPA for loans in the last 2 quarters. So what I think is mostly 40 crore GNPA is coming on 813 crore, which is 5%, significantly higher. So what gives us confidence that we'll be able to scale this channel at a good credit quality?
So the way we have modeled this is that in micro enterprises, also the peak delinquencies happen between 18 to 24 months. And then because we only do secured loans, there is a repossession and then a time about 5 to 6 months to sell that property off. So eventually the peak delinquencies in month 18 to 24 will reach around this percent and then start coming down. So the way currently our GNPA is about 3.8, and we have already started seeing success in repossession of properties. Also, as we expand and as we learn, we keep tweaking our policy, and that has been the journey. So if you recall, our first set of 75 branches operated for a year, and then we took a break on expansion of branches because we wanted to learn the business in its full intricacy. Now that once the learning is there, all the new branches roll out is as per them. So if you see, and we closely monitor the early delinquency indicators for all the new branches, which is basically the bounce rate, 30% in 6 months, and the first 12 months NPA rates, etc. They are all within the range. So all this put together, we think at a steady state level, the delinquencies or the GNPA in micro enterprises will hover around between 3 to 3.5%.
In addition to that, and what Amit, I would add that the mainline financial institution or large banks or NBFC, the degree of difficulty to understand micro enterprises by state and cluster have been a huge challenge. Even within the listed world, we have 2 micro enterprises, NBFC, which are listed, and there are a few more which will come to the market. You will see majority of them are very state focused or too state focused, because the micro enterprises cluster behavior or state behavior of the customer type is fairly unique, depending upon their geography. So Tamil Nadu is a very different geography than UP. So as Rajasthan to Telangana. So we took time to learn this. So we experimented first with 25 location, then 50 location, and that's why we run, while it's a one business, but we run product policy cluster designed by the unique cluster. So the way the collateral policy in Tamil Nadu will work is very different than what would be in UP and MP and Maharashtra. So I think so, size of the platform which we have built and our rapid expansion is a function of that we have invested early on very heavily both in technology, in understanding the credit process, understanding the type of collateral, and then augmenting senior management across the length and breadth of the country. So it's a company in its own, and that's why we were fairly confident that this business can be run at overall GNPA levels of 3.5% and credit cost of 1%. And the payoff of that expansion is very significant to us.
Okay. Yeah, this is it from my side. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Nirvana Laha from Badrinath Holdings. Please go ahead.
Hi, am I audible?
Yes, Mr. Laha.
Yeah, thanks a lot. So, Kishore sir, question is to you. So, in the P&L, the net gain on derecognition of financial instrument, that has DA income and co-lending income, right?
Yes.
Is it possible to give a split between the two for this quarter?
So I would not remember the number exactly offhand. So you can assume that 70% of it would be coming from co-lending and 30% would be coming from DA.
Okay, so just trying to understand that number, sir. So 70% would be like about 70 crores or even above that. Whereas if I look at your presentation, the co-lending AUM in this quarter has increased by about 400 crores from 1830 something to about 22 something. So as I understand, the co-lending income that you report is upfronted for the credit spread, the interest spread for the entire delta in this quarter, right? So
no, this understanding is not correct. So what happened that since Ind-AS has come in 2017, which says that if an asset is derecognized in your book, then the risk and reward has been completely transferred to the counterparty. You don't have the option to do an accounting on EIR basis. If you remember that prior to 2017, when the DA and PTC were quite in existence as it exists now, at that time the accounting on DA was also on EIR. But post 2017, when NBFCs were to migrate to Ind-AS, that optionality was snatched away from the system. Everyone needs to account for the DA and co-lending income for the lifetime income at the NPV. They have to account for. They don't have any other costs. And in our case, what happens that now, since we are doing it for almost 2.5 years now, and where the product cycle is roughly around 3 years, 2 months, so gradually it is the funnel is getting settled down. So whatever we are upfronting in a quarter, almost in 1 or 2 quarters, we'll see that similar amount would have come in form of interest income had we not done this kind of accounting. But this operation will continue to remain as long as we are in this scenario.
Okay, sir. I'll connect with you separately to understand that in more detail. I have two short data points that I want to know. One is, what is the LTV in our micro enterprises portfolio, and out of our total AUM, how much is on fixed interest rates and how much is floating?
So on the LTVs, on a broad portfolio level, in micro enterprises, we would be closer to 50%. And overall, all our secured loan book, which is prime secured, micro secured, and machinery loans, they are on floating rate.
They are on floating. And sir, in terms of repossession, what can you give us some statistics, like how many loans have been made and how many cases of repossession have had to be enacted?
So live to date, we would have repossessed about 100 odd properties out of about total loans, which would have crossed about 4,000, 5,000 in number.
And this is for the micro enterprises segment only?
No, all put together. In micro, it is very small, that part yet, because there's not too many. But now as we move forward in the coming year, we anticipate much more repossession.
Okay. Thank you so much.
Thank you. The next question is from the line of Arpit Agrawal. Please go ahead.
Yes, Arpit.
Mr. Agrawal, your line is unmuted. Please
Am I
proceed
audible?
with your question. Yes.
Yes, you are.
So my question is basically that we have had a good AUM growth, but the profit has not grown with a similar proportion. So the AUM has grown upwards of 30%, but due to credit costs, the profit growth is in the middle of 20%. So what is your forecast regarding this? Will we have operating leverage going ahead, or would the situation be same?
So I will take the question in two parts. As far as operating leverage is concerned, if you look at the number, it has already kicked in. So if you remember our data, 2022, our cost to income ratio was 73%, then it came down to 63%. Last year it was 54%, and if you look at this quarter's data, this is 53%. This is 53%. Probably you may look at it as 1% saving on the previous quarter. However, you have to take into account that we have opened 46 branches, micro branches during this quarter, and almost 100 branches during this year. So despite opening new branches, it takes time to deliver the operating other matrices. We have been quite better off in terms of operating leverage. So that means that all the entire engine is firing well, and our operating costs are going down vis-a-vis the overall asset size and income side. So this is first part of the question. Second part is that you are right that while the AUM has grown by almost 30%, the profits have grown by 22%, largely on account of credit costs going up. As we are seeing that the complete cycle of the books are completing, one cycle we are completing, as we stated earlier in our several other calls, that our model suggests that overall credit cost would be closer to 2%. We would be inching towards that. While we are making our model, we have figured 2%, projected 2% credit cost. If you look at this quarter, which looks higher, but it is still 1.8%. So from 4 to 6 quarters time, it is likely that we will settle closer to 2%. And then it should remain that way unless some macro or microeconomic event happens. So broadly we are in line. probably the other parameters like increase in yield or reduction in borrowing cost will take some more time to settle in. However, directionally we are in the same path which we have directed all of you in our previous conversations.
Okay, thank you.
Thank you. We'll move on to the text questions. The first question is from Arshay Agarwal, and the question is, Ugro Capital achieved a record net loan origination of 1,970 crore in Q2 FY25. Could you explain the key factors behind this strong growth? Was branch expansion the main contributor to this increase? Moreover, do you see this loan origination figure as setting a new base level for the future quarter?
So, partly to this question, Arshay, yes, you answered a part of the question. The branch expansion in quarter one and quarter two is really is one of the drivers to this growth. But you may have also seen that all other business lines have also shown that growth. This is typically also that quarter two is a little better quarter, and the businesses start picking up in quarter two across the country, pre-festive businesses. And so one would see that growth coming in quarter two. Rightly said, this is the new base level for future quarters, and the next quarters will be, in fact, the pace will continue. Our exit run rates in September were upwards of 700 crores, which means that the next quarters will see higher than those run rates, and therefore this is the new base level for us.
Sagar, next.
The next question is from Manoj Bhatia, and the question is, are you planning to get a strategic investor in the company?
Mr. Bhatia, if you have bought shares of Ugro, you are the strategic investor. Our aspiration is to build an institution of size, scale, and solve the problem of the credit. For us, from day one, we got backing of serious private equity investors. We got global DFI to back us. In last round, we saw participation from multiple family offices. And our aspiration is that the way we are growing and what we are building, that larger, broader institutional public market, retail, high net worth and family offices continue to participate in our growth journey, and all of you become our strategic investor. Your support is key to our success. And at this point in time, other than you, we have no insight or no plan to bring any other strategic investor.
Thank you. The next question is from Sunesh Khanna, and the question is, can you please elaborate as to how and when the operating leverage will play out?
Yeah, I think we have already answered this question. Kishore has answered this in others, so we can move on to the next question, please.
Thank you. And the next question is from Aradhana Singh, and the question is, good afternoon, sir. First of all, congratulations for such good quarter. My straightforward question is about not so good effect being reflected in the stock price.
Mr. Singh, it's a very difficult question for a management to answer. While our job is to build business for you and continue doing putting our earnest effort in building and delivering to the metrics what we are promising. Now, stock price sometimes is a reflection of the broader market, and sometimes very hard for us to understand the reason and rationale for that. But whatever I understand at this point of time, the broader narrative of RBI talking about a credit ballooning happening in retail market, RBI commentary on saying banks should not lend to NBFC, and we've seen periodic episodes of few NBFC getting banned, a few segment of the market showing pressure. In that, for public market investors, institutional, retail, high net worth, have little motivation and incentive to call out a particular NBFC and say this is different than the others. But it is just matter of time for any medium to long-term investor. I think so. It is difficult to avoid the size and scale of an creation of an institution which is happening in Ugro. In 3.5 years' time, we have built a 10,000 crore of business. which have never been done in India before. And it is very hard to avoid us. You can look at us, you can be skeptic about us, but eventually will be very difficult for any one of you not to look at us and invest into us. And when that happens, I think so we would be we would have a very good run on us.
Thank you. The next question is from Deepak Yadav, and the question is, number one, when will the SCF be completely out of your books? And out of 355 crore SCF outstanding, how much is recoverable? Second question, was the credit cost of 44 crore in this quarter was the peak, and now onwards this will ease out? And the 16 crore write-off regarding SCF was in this quarter or in the Q1?
So on the supply chain book, out of the total 355 crore outstanding, most of it are very good customers. The NPA within that at this point of time is about 35 crores, and most of that NPA is also in regular course of business through collection effort and litigation. It is likely to be most of it is likely to get recovered. So no big write-offs from that is anticipated. As far as running down is concerned, because it is an evolving business, we do that in consultation with the end customer, and that is why we will ease it out in next few quarters. Some of it is with green assets, which we may not wind down, and it will continue. As far as absolute credit cost of 44 crores is concerned, I think the better way and the correct way to look at credit cost is as a percentage of AUM. We have been modeling that, and our models tell us that we will peak and then stabilize at about 2% or little below 2%. So on absolute number of credit cost, it won't be fair to comment whether we have peaked or not, because we are growing and we will be double of our AUM in next 2-3 years. So that the question should be seen in the right perspective. Yes, the 16 crore write-off in SCF was taken in this quarter and not in Q1.
Thank you.
Mr. Manishka's question we have answered in multiple other questions, so we can move on to the next question.
Sure. The next question is from Subhavel Murugaya, and the question is, what will be the profit growth for second half?
I would say, Mr. Subhavel, that we have given enough data point in terms of how we are progressing. We would not pick out a number and give it to you. We believe that we are in a trajectory to achieve our long-term objectives. When we are confident that our total profitability for this year would be significantly higher than what last year. If you look at our first 2 quarter performance of previous year versus first 2 quarter performance of this year, we are at a very healthy run rate. So I think so, there are a lot of sell side coverage analysts are there. It's their job to model it and give guidance to you, but it should be much better than what it was last year.
Thank you. The next question is from Arpit Agarwal, and the question is, in a total, you mentioned 4 parameters on which you would focus to improve ROA. How has each of the parameter turned out from last quarter?
Mr. Arpit, this bridge to ROA is not a quarterly bridge. It's more directional of what we would like to achieve over a period of when we would be exiting, 2026. On each one of them, you will see a gradual improvement. What definitely you can track. So their bridge is 150 basis point yield increase, 75 basis point cost of borrowing reduction, 0.5% of operating leverage, and negative parameter of credit cost going up by 0.5%. So from what was at that point of time, March 24 of 2.3 to go to 4%. Obviously, what is very easily monitorable by quarter is the portfolio yield enhancement, and that we are definitely seeing that. And that is sheer function of our contribution for micro enterprise business, and that has doubled quarter on quarter. As we have said that we have not seen the reduction on the liability side, and we have to wait out for certain more period. And I have explained that we probably have another 2.5, 3 quarters when we start seeing the benefit of that. Operating leverage, because we are seeing, but actually also simultaneously we are heavily investing in our new branch infrastructure. I think so as we see the maturity curve of another 8 to 9 months, that will kick in. The credit cost we are seeing setting into where the target is. So from a 1.5%, this quarter we saw a little bit of uptick, and I think so it will settle down at 2% as we come to near the end of FY26.
Thank you. The next question is from Deepak Yadav, and the question is, number one, there are many micro and prime branches in AP and MP, but the percent of AUM is merely 2% per state. Why so? And the second question is, ROI of partnership and alliance is 15%, quite lesser than micro enterprise. It was a size of assumption that if the ticket size is less, then ROI is higher. Could you please explain?
So 2 questions, and I will take it one by one. And I think partly Sachin answered this question earlier. The micro and the prime branches, if you look at the evolution, the first set of 75 micro branches were in the states of Tamil Nadu, Telangana, Karnataka, Rajasthan and Gujarat. This set of branches which we've opened now have branches in AP and MP. And that is why the AUM is now building up and it will steadily build up. So it is not that it's low or it's merely 2%. It is just the evolution of branches and the opening times of these branches. On the partnership and alliances, this is the net revenue or the rate to Ugro. The way this works is we work with multiple partners. There is an end customer rate that the partner offers to the customer. And these are the hurdle rates on which we work with. Basically, these rates are, so the 15% is net of any OPEX or very little OPEX and net of losses. We've earlier also expressed that this partnership and alliances business is backed by first loss guarantee. And so there is no further to 15%, there is no drain to this revenue. And so these are extremely good rates. Practically, this is a 4% clean ROA business for us, and that is why it is at 15%.
Next question, please.
Thank you. The next question is from Deep Shah, and the question is, where does the company account for income from co-origination? Is it under income from co-lending/DA? Second question, can you please explain the ESOP vesting conditions for the management?
So on co-origination side, the income is accounted as interest income. So whatever is the differential interest that we get in the partnership. To give you an example, if we have originated a loan at 15%, and if we have co-originated the partner at 11%, then 4% differential interest would get accounted as interest income throughout the life cycle of the loan. So this is the accounting on co-origination. It is quite different from co-lending and direct assignment. As far as ESOP vesting is concerned, it is part of our presentation, and we have earlier stated as well that whatever ESOPs are vested with the management, it is linked with the performance of the equity. So if the equity investors make money, then only the management can exercise its ESOP which are vested in them. The next cycle of ESOP vesting would be coming sometime in 2025 to 2026, subject to stock pricing performing at the agreed level with the management.
Thank you.
Next question.
We have a voice follow-up question from Mr. Anil Tulsiram from Contrarian Value Edge. So please go ahead.
Okay.
Yeah, thank you for the opportunity again. Sir, my question is again on micro enterprises. Since we are operating in tier 2 and cities and below, how do you manage the risk associated with the collateral valuation, and is it in-house or outsourced?
So the collateral valuation is done by our empaneled valuation engineers and closely supervised by an internal in-house technical team.
And I must appreciate your question because it seems like you are aware that certain micro enterprise businesses, the valuation is in-house. We practically as an NBFC are not experts of what valuations are, and so we rely on the experts which are third-party valuers.
That's right.
Got it. And last question is, as per the NCD prospectus, around 25% of the advances are with ticket size of more than 1 crore. So I couldn't correlate this with our business model, why 25% of advances are more than 1 crore. Can you explain this point?
So actually it is not like that. 30% of our AUM is into prime secured, where the average ticket size is about 70 lakhs. So based on the conversion on balance sheet, the disclosure may have gone into the prospectus.
So will we continue to do in this high ticket size? Because I think even if in co-lending there not be much spread or income which we are generating in this.
No, so I think so. Look, if you look at the total volume of our business, our prime secured business, which is a little higher ticket size, would broadly remain static in absolute volume terms. So theoretically, if we have done, say 100 out of our monthly volume of 700 crore, if we did 150 crore of prime secured business, over a period of next 2 years, that 150 crore would remain in the range of 150 crore, or we will go maximum 200 odd crore. But what would grow from this point onward is our micro enterprises grow, right? So I think so once the mix, you start seeing the mix. So today, if you look at exit of FY24, our prime business was roughly around 50%, both between secured business and unsecured business. And our micro enterprise secured business was around 10%. And when this mix would change, this 10% to go 30%, you keep seeing, the transition to lower value secured business happening. But also you remember that one of the drivers, both on the credit cost plus one of the drivers for co-lending is little higher ticket secured business because banks like to do that. So what you are saying is that there is a lesser spread. I agree with you, but also there is a lesser associated credit cost, and also it is also a driver of liquidity and overall portfolio quality to maintain in certain manner. So you have to create a balance around all of that. You have to create a balance around high profitability, high ROA, but you have to keep, as a builders of institution, we have to keep in mind what would happen over a period of 3 years, 2 years, so on and so forth.
Got it. So my last question is on co-lending. What's the progress on co-lending with Tata Capital, Godrej and Mahindra, and how much we are able to scale up the book, technical integration, all other things?
No, so I think, look, we don't, neither we disclose it, because, they are all very large listed companies, so we don't know what their public disclosures are. So it's very hard for them without their consent to give you that disclosure. What I would say, broadly say that, look, we would like to have what we take pride in, that large leading banks of India, all of the public sector banks, the SBIs and, Central Bank, the Bank of Baroda, the, IDBI, all of them, UCO, all of them are our partners. We have all of our large NBFCs in this country which has been in existence. They have approved our origination and credit quality as our partners, and we are now seeing a lot of big private sector bank also becoming our partner. We would like to maintain the mix. We would like to have active 6-7 partners, and we'd like to do business with each one of them. Over quarter by quarter, some would be higher, some would be lesser, but that is all okay with us.
No, let me put this question in different manner. What I meant is earlier top 3-4 were accounting for more than 70-80% of the co-lending book. So is the situation persist like that, or has it changed?
No, it is getting more diversified, sir. So there are two very clear and distinct trends. So our co-origination volume, which was largely with NBFCs, is coming down, and co-lending volume with the banks is going up. It is happening because one segment of the market, which was business loan, was earlier not being done by banks, but after the application of credit guarantee scheme on co-lending, banks have started taking business loan also under the co-lending. So broad commentary is that our business participation of business with NBFC have gone down, but we would like to maintain certain percentage of our business with NBFC as well. Second, the concentration with only business with few banks are very well diversified. I think so over a period of next 2 quarters, no bank would be more than bank or an NBFC would be more than 25% of our total co-lending volume.
Got it, sir. Thank you. That's it from my side. Thanks a lot and all the best.
Thank you so much.
Thank you. The last question is a text question from Mr. Deepak Yadav, and the question is, number one, you have sold 50 crore worth of loan to ARC. Were they predominantly SCF loans? How much haircut you took here? And do you plan to sell more in the fiscal? And number two, on a conservative basis, how much should be the AUM and ROA by the end of this financial year? All the best for the next quarter.
On the ARC question, it was a combination of business loans, unsecured and supply chain, and we haven't taken any haircut. And we don't plan as of now to do any more of this kind of a transaction.
It was done in cash.
It was an all cash deal. And on the AUM and ROA forecast,
I guess our trajectory and is given. As I have said earlier, that our job is to guide all of our shareholder partners, investors, existing and prospective, on our long-term vision, growth plan, what this company plans to achieve, and how we are building an institution. Because we have 6-7 sell-side coverages, analysts actually do deep dig analysis and project, what would be our AUM's growth, ROA growth, and they also give comparatives. So I would urge all of you, when they do the coverages, when they do the quarterly analysis, please look at and read them and take a mean of that, and they are more appropriate. We have deep conviction and commitment of what we are building, and we'll continue to do that. Sometimes we have to look away from quarter to quarter performance and remain our focus on what we are building for long term. And we are hoping that we will have shareholder partners who would also look at in the similar fashion as we are looking at this business.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Deepak Khetan for closing comments. Over to you, sir.
Thank you, Sagar. Thank you all for the queries and your continued support. Please feel free to reach out to me and my colleague Viral if we have not answered any of your query or you have additional queries. I would like to thank Chorus and JM Financial to help us organize this call today. Look forward for your continued support going ahead, and thank you. Have a good evening.
Thank you.
Happy Diwali.
Happy Diwali.
Thank you very much, sir. Thank you. Members of the management, ladies and gentlemen, on behalf of Ugro Capital Ltd, that concludes this conference. Thank you for joining us, and you may now exit the meeting.